What if I told you there's a $6,000 deduction sitting in the 2026 tax code that over 70% of eligible Americans don't know exists? What if you could earn up to $98,900 as a married couple and pay zero federal tax on investment gains? What if the way you're calculating your tax bracket is wrong and it's costing you money? The 2026 tax brackets just shifted. Standard deductions increased, capital gains thresholds moved. Buried in the fine print is a temporary bonus for anyone 65 or older that's available through 2028, but nobody's talking about it. The changes happened quietly, no headlines, just a dense IRS document that 95% of taxpayers will never read. Picture this, you're staring at your paycheck, taxes coming out. You think, I'm in the 24% bracket, so I'm paying 24% on everything. Wrong, you're actually paying way less because of how marginal rates work. Or you sell stocks, you assume 15% capital gains tax. Wrong again, depending on your income, you might pay zero. Or if you're holding physical gold, you might be paying 28% when you thought it was 15%. The system is designed to confuse you. Confusion costs money. Here's what's happening in 2026. Single filers get $16,100 in standard deduction. Married couples get $32,200. 65 or older, add another $2,050 if you're single or $3,300 if you're married filing jointly. Qualify for that temporary $6,000 senior deduction? Your taxable income just dropped by tens of thousands. But most people won't claim it. They'll leave it on the table, pay more than they need to, never know the difference. Hi, I'm Matt. On this channel, I break down complex financial topics into strategies you can actually use, and I help you keep more of your hard-earned money by understanding how the system works. If that sounds valuable, hit subscribe right now, because we're about to dig into every single change that matters for 2026. Let's start with the foundation, because this affects everyone. The standard deduction. It's the amount of your income that the IRS doesn't tax at all. It's your baseline protection. And for 2026, those numbers just went up across the board. Single filers get $16,100. Married couples filing jointly get $32,200. Head of household, $24,150. These might not sound like massive increases compared to 2025, but here's what people miss. That $350 bump for single filers isn't just $350. It's $350 that would have been taxed at your marginal rate. If you're in the 22% bracket, that's $77 back in your pocket. If you're in the 24% bracket, that's $84. Multiply that by everyone filing taxes in America, and we're talking about billions of dollars shifting. But the real story here is the senior deduction. If you're 65 or older, you get an additional standard deduction on top of the regular amount. For 2026, that's $2,050 if you're single, $1,650 if you're married. Now, this isn't new. This has existed for years. But what is new is the $6,000 bonus that came from the One Big Beautiful Bill Act that passed in July 2025. Here's how it works. If you're 65 or older, you can deduct an extra $6,000 from your taxable income for tax years 2025 through 2028. That's per person. So if you're a married couple where both spouses are 65 plus, that's $12,000 combined, on top of your regular standard deduction, on top of the additional senior amounts. Let me show you what this looks like with real numbers. Imagine you're a married couple, both 67 years old, with $150,000 in combined income. Your standard deduction for 2026 is $32,200. Add the senior amounts for both of you, that's $3,300 more. Then add the $6,000 bonus for each of you, that's $12,000 more. Your total deductions, $47,500. You're only paying taxes on $102,500 of that $150,000 income. Now there's a catch. The $6,000 senior deduction starts phasing out at $75,000 for single filers and $150,000 for married couples. It reduces by 6% for every dollar over those thresholds. So if you're right at that edge, you need to run the numbers carefully. But if you're below those limits, this is a massive gift. What percentage of retirees do you think actually know about this deduction? I'd bet it's under 30%, and that's the problem with IRS tax changes. They happen quietly, they get buried in press releases, and millions of people leave money on the table because nobody explained it in plain English. But here's what nobody tells you about that $6,000 deduction. It's only around for 4 years, 2025 through 2028. After that, it expires unless Congress extends it. So if you're planning your retirement timeline, if you're thinking about when to take Social Security, when to do Roth conversions, when to realize capital gains, you need to factor this window into your strategy, because once it's gone, your tax situation changes dramatically. Think about it this way. A 65-year-old couple with this deduction has a completely different tax picture than they will in 2029. That 4-year window is your opportunity to do strategic moves you might not be able to do later. Convert more from traditional IRA to Roth while your taxable income is artificially suppressed. Realize capital gains at 0% rate. Take required minimum distributions without the same tax hit. The clock is ticking on this benefit, and most people aren't even aware it exists. Here's another angle. If you're 64 right now, turning 65 in 2026, you get 3 full years of this $6,000 deduction before it expires. That's $18,000 in extra deductions over 3 years. If you're in the 22% bracket, that's nearly $4,000 in tax savings just from waiting to turn 65 at the right time. Timing matters in tax planning more than people realize. And for couples where one spouse is 65 and the other isn't yet, you still get the full $6,000 for the qualifying spouse. It's not prorated, it's not reduced. If one of you hits the age threshold, that $6,000 is yours. So if you're a couple where one spouse is 66 and the other is 63, you're getting $6,000 now and you'll get $12,000 once both qualify. Now let's talk about where your money goes after those deductions. The United States has 7 federal income tax brackets for 2026, and understanding how they work is the difference between feeling crushed by taxes and having control. The brackets are 10%, 12, 22, 24, 32, 35, and 37. Those rates haven't changed, but the income ranges where they kick in were adjusted for inflation. Critical thing most people get wrong. Our tax system is progressive. You don't pay one flat rate on all income. You pay different rates on different chunks. Think of climbing a ladder. Each rung represents a bracket. You pay the rate for each step as you climb, not one rate on total distance. Let me walk you through 2026 numbers for single filers. After your standard deduction, the first $12,400 of taxable income is taxed at 10%. The next $38,000 from $12,400 up to $50,400 is taxed at 12%. The next $55,300 from $50,400 up to $105,700 is taxed at 22%, and it keeps climbing. For married couples filing jointly, those ranges roughly double. First $24,800 is at 10%. Next $76,000 from $24,800 up to $100,800 is at 12%. Here's why this matters. Let's say you're single and taxable income for 2026 is $60,000. People hear, I'm in the 22% bracket and panic thinking they're paying 22% on all $60,000. Wrong. You're paying 10% on first $12,400. That's $1,240 in tax. Then 12% on next $38,000. That's $4,560. Then 22% on remaining $9,600. That's $2,112. Total tax, $7,912. Effective rate, about 13%, not 22%. This is what I mean when I say understanding the system gives you power. When you know how marginal rates work, you can make smarter decisions about year-end bonuses, Roth conversions, when to realize capital gains. Pause for a second. What percentage are you paying in taxes? Not marginal rate, actual effective rate. Most people have no idea. They see the big number on their W-2, see a number come out in April and accept it. But if you can't answer that question, you can't optimize anything. The 2026 IRS tax changes included something interesting. The lowest 2 brackets, 10 and 12% ranges, got 4% inflation adjustment. Higher brackets only got 2.3%. Why does that matter? More of your income can stay in lower brackets before spilling into higher ones. For someone earning $50,000 to $60,000, that could mean a few hundred in savings. Top bracket is still 37%, kicking in at $640,600 for single filers and $768,700 for married couples. If you're near those numbers, you're working with a CPA. But for 95% of filers in the 10 to 24% brackets, these adjustments matter. We're halfway through, and if you're still here, you're ahead of 95% of taxpayers who have no idea these changes exist. Here's where it gets interesting. Everything we just covered, that's ordinary income. Wages, salaries, freelance payments, short-term investment gains, but there's a completely different system for long-term capital gains, and understanding the difference is where real wealth gets built. Capital gains are profits from selling investments held more than a year: stocks, bonds, real estate, ETFs. When you buy, wait 12 months, and sell for more, that profit is a long-term capital gain. The IRS taxes it differently than your paycheck. There are three rates for long-term capital gains in 2026: 0%, 15%, 20%. Your gains stack on top of your ordinary income. Picture a tower. The base is your wages after deductions. Capital gains layer on top. The IRS looks at total height and determines which rate applies. For single filers in 2026, if total taxable income is under $49,400, your long-term capital gains rate is 0. Between $49,400 and $545,500, 15%. Above that, 20%. For married couples, those numbers almost double. Under $98,900, 0%. Between $98,900 and $613,700, 15%. Above that, 20%. Real example. Married couple, combined salaries $80,000. After the $32,200 standard deduction, taxable ordinary income is $47,800. They sell stocks held 3 years, $200,000 in long-term capital gains. That $47,800 in ordinary income gets taxed at regular brackets, then $200,000 in gains stacks on top. Total taxable income is $247,800, but the first $98,900 of combined income falls under 0% capital gains threshold. So the first $51,100 of gains, the portion keeping them under $98,900 total, 0 federal tax. The remaining $148,900 in gains gets taxed at 15%. That's $22,335 in federal capital gains tax on $200,000 profit. If those gains were ordinary income at marginal rates, they'd pay significantly more. This is why wealthy people emphasize capital gains. It's not a loophole. It's literally in the tax code to encourage long-term investing. The government wants you to hold assets over a year because it stabilizes markets, so they give you a better rate. But there's a trap for high earners. If modified adjusted gross income exceeds $200,000 for single filers or $250,000 married, you get hit with an additional 3.8% net investment income tax on top of capital gains rate. So 15% becomes 18.8, 20% becomes 23.8. Would you rather pay 15% or 28% on the same investment? Hold that thought. In a minute, I'll show you an investment where the IRS forces you into the higher rate no matter your bracket. Remember when I asked you to write down your effective tax rate? Go back to that number. Most people drastically overestimate because they're thinking marginal rate on wages. But if a big chunk comes from investments, actual effective rate could be way lower. A married couple with $50,000 in wages and $100,000 in long-term gains might have effective federal rate under 10% when averaged out. The 2026 capital gains tax brackets increased slightly from 2025 for inflation. For married couples, the 0% threshold went from $96,700 in 2025 to $98,900 in 2026. That's extra $2,200 that can be taxed at 0. For someone strategically realizing gains every year, that adds up. Everything I just told you about capital gains doesn't apply if you invest in physical gold or silver. The IRS classifies precious metals as collectibles, and collectibles get hit with completely different rules. Collectibles include art, antiques, stamps, coins, and physical precious metals. Gold bars, silver coins, platinum, palladium. If you can hold it in your hand, the IRS treats it differently than stocks, and that difference costs you. The rule: long-term capital gains on collectibles are taxed at your ordinary income rate, up to a maximum of 28%. Not 0, 15, or 20, your ordinary rate, capped at 28. If you're in the 12% bracket, you pay 12 on gold gains. 24% bracket, you pay 24. 32 or 37 bracket, you pay the maximum collectible rate of 28%. Real example, you buy 100 ounces of gold in 2023 at $1,800 per ounce, $180,000 investment. You sell in 2026 at $2,600 per ounce, $260,000 proceeds, $80,000 gain. You held over a year, so it's long term, but because it's gold, it's a collectible. If you're in the 32% bracket, you pay the capped collectible rate of 28% on that 80,000 gain, $22,400 in federal tax. If that same gain came from stocks held over a year, you'd pay 15 or 20%. Let's say 15. That's 12,000. The gold cost you 10,400 more in taxes just because of IRS classification. Do you own any gold or silver? If you do, factor this into your strategy. Physical precious metals can hedge inflation and diversify portfolios, but from a pure tax perspective, they're less efficient than stocks, bonds, or real estate. Now, there's a workaround. Instead of buying physical gold, buy gold ETFs that track gold price. Some ETFs hold physical metal in vaults, and IRS still treats those as collectibles. But other gold ETFs use futures contracts instead of holding physical. Those get taxed under 60-40 rule. 60% of gains treated as long-term at lower capital gains rates, 40% treated as short-term at ordinary rates. It's complicated, but for many investors, more tax efficient than owning physical gold. Same applies to silver. Physical silver coins or bars, collectible, taxed up to 28%. Silver mining stocks, regular securities, taxed at standard capital gains rates. Most people who invest in gold and silver do it because they're worried about economic instability, inflation, market crashes. They're trying to protect wealth, but the tax code punishes them by forcing them into a higher rate than stocks. It's one of those quirks that doesn't make intuitive sense unless you understand Congress wrote these rules decades ago and hasn't updated them. If you're sitting on physical precious metals and thinking about selling, map your strategy carefully. If you're in 22 or 24% bracket, your collectible rate is 22 or 24%. But if you're expecting big income spike that pushes you into 32 or 35, realize those gains while the rate is lower. Now let's put all this together into a plan you can actually execute this year. So you've made it this far. You understand the 2026 standard deductions, the 7 tax brackets, capital gains rates, and the collectibles trap. Now what? How do you actually use this to keep more of your money? First, maximize your deductions. If you're 65 or older and qualify for that $6,000 senior deduction, claim it. It's only available through 2028. If you're close to the phase-out at $75,000 single or $150,000 married, reduce your modified adjusted gross income through 401k or IRA contributions to stay below the threshold. Second, think strategically about capital gains. If you're a married couple with income below $98,900 after deductions, you're in the 0% capital gains bracket. Sell stocks with gains this year, pay 0 tax, and immediately buy them back if you want. There's no wash sale rule on gains. It's called tax gain harvesting, and most people never use it. Third, manage your brackets. If you're hovering near a bracket edge, defer income or max out pre-tax retirement contributions. Every dollar you keep in a lower bracket is money saved. Fourth, time your Roth conversions. With the senior deduction available through 2028, some retirees have a temporary window where taxable income is artificially lower. That's the time to convert traditional IRA money to Roth and lock in tax-free growth. Fifth, review your withholding. The IRS updated 2026 withholding tables for these changes. If your paycheck hasn't adjusted, you might be over or under withholding. Run a checkup on the IRS website or talk to HR. Let me show you what this looks like. Single filer, age 68, with $60,000 in Social Security and $20,000 in consulting income. Standard deduction, $16,100. Senior deduction, $2,050. $6,000 bonus. Total deductions, $24,150. Taxable income, $55,850. Sell stocks with $30,000 in gains. Total taxable income, $85,850. Still under the threshold, so capital gains rate is 0%. $30,000 in profit, 0 federal tax. That's the power of understanding these rules. That person could have sold in a different year and paid 15%, $4,500 difference. Compare 2026 to 2025. Standard deduction up $350 for singles, $700 for married. Brackets expanded 2 to 4%. Capital gains thresholds increased $2,000. For a median earner, that's $100 to $300 in savings just from inflation adjustments. The One Big Beautiful Bill Act made most of this structure permanent, so these aren't temporary brackets disappearing next year. If you take one thing from this video, let it be this. The IRS changes rules every year. The 2026 tax brackets aren't front-page news, but they impact everyone who earns income, invests money, or plans for retirement. Most people don't pay attention until it's too late. Now you know what changed and how to use it. What's your move this year? Are you harvesting gains, maxing retirement accounts, planning Roth conversions, or doing what 95% do and letting it happen to you?